Welcome everyone to Charts Focus 1, where we teach you how to work hard and trade smart. In this live stream recap video, I want to talk about how we caught this triple percentage return on Apple at the highs today. Now this trade is a very high risk swing that is working out perfectly because we have swung it over the weekend. But before I go over this amazing swing trade, I want to talk about something that I didn't get to talk about at the end of last year in December. I have been thinking about creating a separate video for you all on this topic, but I was very hesitant. And because of my hesitance, time went by and I didn't get the chance to tell you guys what I wanted to say. I had everything written out as well. But you know what? It's never too late. I will tell you guys exactly what I was trying to convey to you all as if it's December right now. So let's travel back in time. Now before I get into what I want to tell you guys, make sure you guys watch the opening statement of Jerome Powell's conference that occurred in the last FOMC meeting of 2022. The link to that video will be in the description box below. So pause this video right now, watch that nearly 10-minute opening statement, and then come back to this video. The information that I will tell you guys in the next couple of minutes will be related to what Jerome Powell said in his conference. Now let me tell you a disclaimer. The following statements are my personal opinions that should not be taken as serious investment advice for any future investment opportunities that you may take. I am not a certified financial advisor. With that being said, let's go over what I told my CFO Swing and Watch members after the FOMC meeting results came out and what Jerome Powell said during the exclusive live stream that occurred that day. So first of all, the expected 50 BP or basis points interest rate hike came in as expected as the Federal Reserve hiked by 50 BP. So this brings the federal funds rate, the FFR, to 4.25% to 4.50%. Again, 4.25% to 4.50%. The market moved lower on this move by the Federal Reserve, and the market moved even lower when Jerome Powell gave his opening statement. I hypothesized that this would happen, but of course, not in 100% confidence since no one can tell the future. Now, how did I do this? And how did I come up with this hypothesis? Well, when the CPI data came out way lower than expected at 7.1% actual versus 7.3% expected, I told my members that this is a huge move in the inflation data because it really is a big move. October's inflation data was 7.7%, which was in itself a move lower, and then we get this November inflation data at 7.1%. So the market reacted immensely positively to the upside, and rightfully so. So if you guys remember, CPI data came out on this specific candlestick on December 13th, and the markets moved up a lot pre-market right after that data came out, and we ended up opening at $408.34 from the previous night's close of $397.13. So that's a very, very large move. Now, I told them that this large move worried me, largely because of the fact that the market is most likely discounting what the Federal Reserve was going to do the very next day. So what does this mean? With such a large move in inflation, it was almost obvious that the Fed will cut rates to 50 BP or basis points, so the market had already discounted that future Fed move along with the CPI data before the rate results came out a day later. So this is the candlestick that you guys can see when the CPI data came out, and on the same day, we saw the price coming back down, okay, and eating away that gap up that we made, the gains that we made from that gap up. And then the following day, okay, we did not get a larger reaction compared to the inflation data, because remember, the Fed's action on what the CPI showed is a lot more important. And that's the reason why I was saying and telling my CFO Swing on Watch members that there is a huge possibility that the market had already discounted what the Federal Reserve will be doing and what the results will be for this last FOMC meeting of 2022. Now, this was very important because I told my members that there is a high probability that we can go lower for the rest of the week, as we also had OPEX, where 4 asset classes were going to be expiring simultaneously on Friday. And this almost always gives us a red day. And in hindsight, that's exactly what we got. So if you take a look at this half of the week here, at this specific area, okay, we ended up drastically down compared to where we started off on Monday. And we saw a huge amount of selling volume coming in, and the price continued to pull back from the highs that we made from that CPI data day. However, you guys have to remember this. The breadth of the market continued to get better even if the market was pulling back hard after that week. Now, with that information, this is what I was expecting back in December and what I was about to tell you guys in December. I said, I am slightly bullish for next year. Jerome Powell is extremely dedicated to bring down inflation to 2% with more members of the Fed joining. Their ultimate goal is having the federal funds rate to top out at 5% minimum in the next fiscal year of 2023. Now, what was most interesting about this last FOMC meeting and conference for 2022 is that he began to mention the potential future conflicts and consequences of the crazy fast interest rate hike cycle they've started, with the addition of their QT or quantitative tightening / decreasing of their balance sheet. Now, if you guys remember, they have ballooned the balance sheet for the last 2 years. Now, before the trading week even started, I mentioned to my members that the Fed will most likely be cautious for the last meeting of this year, as they need to set the tone for the new upcoming fiscal year of 2023. Cautious about what, you may ask? Well, about making a second mistake. They caused inflation by printing billions of dollars to push into the money supply in order to stimulate the economy and the stock market, even though they could have and should have stopped at a certain point. So are they willing to make a second mistake? Absolutely not. Sure, I understand that they will do whatever it takes to bring inflation down. But remember, this is one of the fastest interest rate hike cycles in decades, because the Fed does not want to follow history where the Federal Reserve didn't hike rates fast enough in the 1970s, and also does not want to create a new current precedent where inflation becomes eternally entrenched in the economy by staying above their target 2% number. Now, obviously, this sounds very bearish in the short term, as the markets will obviously not like more interest rate hikes. But in the long term, this is great news. Why? Because the Federal Reserve is doing the job that they're supposed to be doing. Inflation needs to come down fast. And we have seen the beginning of that with the difference of data month over month. Now, if inflation doesn't come down quickly, there is a higher probability of the Federal Reserve causing a deeper recession, which they absolutely don't want, as that would be a major second mistake that they will be making within a 3-year time frame, along with the other potential mistake aforementioned. Also, the Federal Reserve knows for a fact that their actions will have an effect on the broader economy and the tight labor market. You guys can also call it a very resilient labor market. Now, this means that they know that the UR, or unemployment rate, will have to spike higher from these lows, and the economy will have to drastically slow down in growth. So far, we have been seeing the labor market staying relatively stable, as the UR is oscillating between 3.5% to 3.7%, which is on average very, very low from the past 50 decades, okay, 50 years. Not 50 decades, 50 years. The economy has yet to drastically contract, as we have been seeing slower growth, quote unquote, slower growth from the economy so far, as consumer spending and retail sales are still up. So my personal view right now is limbo. The underlying economic conditions continue to worsen, but inflation is rapidly starting to cool, as it peaked at 9.1% in the month of June of this year. The Federal Reserve will continue to rely on incoming data. Remember, they even said this. They're going to rely on incoming data every single month to consider their next course of action. I personally believe that inflation will continue to oscillate up and down, but with the general trend to the downside, as I've repeatedly stated since the start of this year. Okay, that is it for what I wanted to tell you all last December. So let's rewind the time back to the present and talk about this Apple swing trade to the upside. So hopefully all the information can be used in your own perspective of the future market price action and where the market can go in the next couple of years. So the first thing that I noticed was that Apple was lagging behind the market. And the benchmark for the market is the S&P 500, or SPY, as you all should know by now. And guess what? Apple has about a 7.1% weight on SPY, and compared to SPY, it has been downtrending for weeks, whilst SPY was simply consolidating and moving sideways. Okay, so if you take a look on Apple right here, we have been moving down and down and down, making lower lows and lower highs. And then if you take a look at SPY, SPY has been moving sideways, consolidating within a very tight price range. Now, I won't be showing my exact entry, timestamp, and call contract, just like in the previous live stream recap video, but there is a screenshot available on my Instagram that gives you a small hint of when we got in. So make sure to check out that timestamp in my Instagram story. And also, I will give you guys a hint by giving you a nice specific area of where we could have gotten in using these yellow lines. So if we go on the 15-minute time frame, this is the specific area where we got in. Okay, and if you guys use the hint from the Instagram story and come back to the chart in this 15-minute time frame to this specific area, you guys might figure out where we could have gotten in. Now, of course, if you want the full details of this swing trade, make sure you join the CFO Swinger Watch newsletter to gain full access to the private CFO Discord. The link is in the description box below. It's the very second link, so it's very hard to miss. Now, Apple was lagging behind SPY, so why did I take it? Shouldn't I be more wary about a laggard when the overall market is moving higher? Because there's a possibility that this laggard can continue to move to the downside and completely decouple from what the market is doing. Well, since we're talking about Apple here with a 7.1% weight in the S&P 500, it would logically make sense that if Apple starts to reverse higher, then the market will continue to move higher as well. And since Apple is lagging behind on the overall market bounce that we saw today, if Apple continues to reverse higher next week, we can see the market continue to move to the upside. And so at the end of today, we saw Apple closing in at 71% for our swing position and then hitting around 112% plus near the high of the day. Now, considering the future price action, let's quickly go over the technical analysis for Apple and what I expect for next week, because I expect Apple to continue to run upwards as shown on the daily and weekly time frame. So first of all, what is shown on the weekly time frame? Well, this week, the very first week of January of 2023, we have a very nice hammer candlestick. Now, it doesn't matter if it's red or green. All we need to know is that, well, this very, very long wick, this bottom wick or lower shadow has been made. And this is giving us information that sellers were not able to sustain a push lower on the share price, and buyers were able to come back in and push all those sellers out, bidding the price back higher. And so this tells me that there is going to be some type of a seller exhaustion on the weekly time frame. And that could mean that we can be seeing at least 2 weeks of a larger bounce to the upside. And if you take a look at my moving averages, the 10 and 21 especially, we have moved so far away from these two moving averages. And this is what we can call a mean reversion trade, where the price comes back to retest a major SMA like the 10 and the 21. So if we do decide to bounce for the next couple of weeks, like 2 weeks, we should be able to see another retest of the weekly 10 and eventually the weekly 21 SMAs. Now with that longer perspective in mind, for next week, I am very positive on being bullish for Apple because number one, we closed above the 10 SMA on the daily time frame, this red line, for the first time since we have broken below it after that entire debacle with CPI data coming out and the FOMC meeting results. So it's been almost a month here. And for the fact that we have closed above the 10 SMA gives me more hope that the sentiment and the price trend could be changing for next week. And especially if we're able to get back above this intraday level of resistance at 130 next week, we should be able to see a continuation to the upside. And you can clearly tell that today we rejected at the highs of the day at 130.29, which is basically that 130 level that I've been looking at for some time now. And because the fact that we were able to retest 130 and also close very close to 130, only a couple cents here, and close above the 10 SMA, I wholeheartedly believe that we can see a retest of 132 and eventually my maximum profit target of 134. And why 134? Well, because right now the 21 SMA is sitting right on top of it. Now, I'm not going to say that, when we do retest the 21 SMA, it's going to sit at 134. I expect the 21 SMA to be retested around, I would say, 132.50 to 133. And this could only happen if the price moves upwards, okay? If there's a lot of momentum to the upside and a lot of buying momentum coming in as well. So this 134 level is a very significant level that we can most likely reach because it was a huge magnet level, specifically a level of support multiple times in the past. So right here and right over here. So obviously we broke it, but that does not mean that we can't come back to it and retest it. So overall, Apple is still in the downtrend. But like I said, this could be a great mean reversion trade on the weekly time frame. So there's a good possibility that we can retest this very significant level of resistance at 134. All right, that is it for this video. If you liked what you heard, please leave a thumbs up down below. And if you're new here, check out the description box below for the subscription link to the CFO Swinger Watch newsletter. And make sure you guys check out the other live stream recap videos to continue your learning in trading. Thank you all for watching.